What the heck is HIT investing?
HIT investing stands for high impact investing while leveraging technology. While impact investors are trying to generate commercial returns and they're going after these sectors because there's an opportunity to generate huge commercial returns. They'll be out of business very soon. They provide loans at 18 to 20% to Kirana stores or retail outlets who would otherwise not get that loan even at 25% after giving property as collateral. India is one market which gives you a lot of volumes to be able to drive those returns.
We keep saying India is a very cost conscious market. I really feel we're a value conscious market.
There is no impact in having to shut down the business and fire 100 people. Ultimately, you need to figure out models which are able to sustain. So for the impact to sustain, the business has to sustain. It is very important for everybody to incorporate this in their solution, right? Otherwise, you'll be left behind.
Hi, everybody. Welcome again to this next episode of the Prime Venture Partners podcast, where we bring you stories from entrepreneurs and the startup ecosystem in general. My guest today is Mahesh Joshi. He is with BlueOrchard and is a very happy co-investors in Finag, which is why you see my Finag t-shirt on today. Mahesh, welcome to our podcast.
Thank you so much, Sanjay. Thanks for inviting me. Great to be here.
So Mahesh is here not in the capacity of a Finag board member or as another VC, but actually as an author who has written a book on HIT investing. So the obvious question is, what the heck is HIT investing?
Yes, so HIT investing stands for high impact investing while leveraging technology.
Got it.
Right. So the book itself, I mean, we talk about various impact investors who have been able to achieve great returns while doing a lot of social good. And a theme across all these investors is they have used new age technology to be able to drive affordability and accessibility of a lot of these products and services. And that is where the name HIT investing comes from.
Got it. Now, you told me privately that there were some other acronyms that were being
Ye-
considered for the name of
Yes.
the book.
Yeah, so initially the name of the book was The Mad Investors, MAD, which stands for Making a Difference. And this was the name that Penguin came up with. It was very interesting, and they thought that this will also be provocative enough, and will get a lot of people to pick up the book and at least see what it is. But and very rightly, some of the investors pointed out that it would not be right because while they were okay, it might not be the right way of representing the entire impact industry,
Right.
right? Because this can be picked up in a very wrong way by different people, and that is when we decided to change the name.
Well, I hope you have a big hit with the word hit investing and with the book. Maybe you can back off a little bit. Tell us a little bit about your background and how you got into high impact investing or leveraging technology.
Yeah, so I had spent 10 years in private equity in India across Franklin Templeton's private equity arm called Darby, then IDFC private equity, which then has become InvestCorp. And then I joined Leapfrog Investments. And it was completely by chance. I was not thinking of getting into impact investing, but Leapfrog is now one of the largest investors in impact on the equity side, and they were looking for somebody to handle healthcare out of Asia for the entire Asia, and India is a focus market for them. So they ended up finding somebody. They were looking for somebody to address healthcare. What I really liked about that role, I was not too much focused on impact investing, but what I really liked about that role is that it gave me the opportunity to look at the entire wider geography. So I was doing largely India at that point of time. It gave me the opportunity to do Southeast Asia and other geographies as well. And then it also I really liked the people who were working there. So people leading healthcare there were Michael Fernandez and Dr. Felix Solale. Both of them McKinsey people from McKinsey. I had great feedback on Michael. Everybody said that he's a great person to work with, and it turned out to be equally great. And so those are what led me to impact investing. But then again, what led me to this book from impact investing is that when I was outside of impact investing, there's a certain way in which I perceived impact investing.
Hmm.
And after a few years, I'd forgotten how I'd perceived that. But then there were some questions, whenever I have conversations, people, the questions come up. And I thought that, there's a lot of miscommunication about what it means and how it works. And I thought the best way to address that would be to show the results of some of the people who have been, doing this well. And that's how the concept and the thought for the book came.
Wonderful. So maybe we can dive in a little further on what you just said, which is what are some of the key misconceptions or yeah, that people have about impact investing?
Yeah, so even when I was first of all, I think people outside don't understand the impact investing very well, right? It's equated to philanthropy by some people. And I would not, I would say that is wrong because impact investing as a definition covers all of that. So, impact investing covers the entire spectrum from philanthropy all the way to commercial capital and with, sorry, with even blended finance in between. The but a large part of that happens on the commercial side,
Hmm.
right? Though there is some philanthropy involved, there is some blended finance involved, and the people that we cover in the book are all commercial investors, right? So that is the key difference. I mean, people are not able to understand outside of impact investing that there's a wide spectrum of impact investing. The other thing is that in general, because of this, people generally perceive that impact investing has access to concessionary capital and they don't need commercial returns,
Mm.
right? While it's the completely other way around. While impact investors are trying to generate commercial returns and they're going after these sectors because there's an opportunity to generate huge commercial returns. And
Got
that
it.
is what we're trying to bring out that and also so at Leapfrog or at Blue Orchard we also run funds and if we don't generate returns we'll be out of business very soon, right? So that is the reality.
Got it. Got it. So perhaps we can discuss a couple of examples, maybe from the book itself, whether it's other investors or through your own journey. Companies which are, very, very successful, have generated strong, solid returns for investors, for founders, and yet are classified in your mind as impact investments. Because there's also a little bit of subject to interpretation, I guess, some of this
Yeah,
aspect of it,
yeah.
right? And maybe as a follow-on question, or I can come back to that later, what would you see and say, okay, this is not an impact investment, right? So we can come back to that separately, but maybe we can start with some examples for the audience.
Yeah, so see, it is impact investing definition itself is very,
Subjective.
it's subjective, but at least for a long period of time, it was unclear as well. So the impact investing term got coined in 2007.
Hmm.
In 2018 or 2019, IFC came up with a report where they defined what impact investing is for the first time.
Hmm.
And they said you need three things for something to be called an impact investment. The first one is intent, right? So you have to define what is the intent that you're trying to, what is your intent and what are you trying to solve? Is it that you're trying to solve healthcare affordability and accessibility? Are you trying to solve for inclusion? Are you trying to solve for a wide segment of the population saying that these low and mid income people is what I need to upgrade? So you decide what it is. Then you have to contribute towards those investments. And it becomes easier to do that in the private world rather than in the public world because we are on the boards of the companies, we guide them on the direction. So there's a lot of hand holding we can do, support we can provide that counts as contribution. And then you should, whatever targets that you started with, saying that this is what I want to achieve, you should measure whether
Hmm.
you're achieving those goals or not, right? That is, again,
Got it.
so
So there's intent, there's action, and then there is
yeah, intent,
measurement.
contribution, and measurement. You have to fulfill these three things to be called an impact investor. Now, if you look at the intent itself can be very wide and it can be different for different people, right? While I was at Leapfrog, my focus was on healthcare affordability and accessibility.
Hmm.
Leapfrog had a slightly wider mandate. They were focused on wider financial services and healthcare. At Blue Orchard, our focus is on climate resilience through insurance. So a very niche mandate, and we focus on much narrower set of opportunities. But that is the impact that we have chosen for ourselves.
Got it.
So within that, but essentially, in general, if you look at the wider impact definition, it's about solving for the low and middle income people, right? And one good example, that is not in the book, but that is, both of us are privy to is Finag,
Mhm.
right? Excellent business. I find Finag's business really beautiful. They provide loans at 18 to 20% to Kirana stores or retail outlets who would otherwise not get that loan even at 25% after giving property as collateral,
Mm.
right? In
And
that
these are
sense, it's
working capital loans. Yeah.
these are working capital loans, but even that access to capital is not possible for them without somebody like Finag. Then the way
And
they're
actually, from what we have experienced, a good chunk of these are owned by women as well, right? So there's that element of inclusion of
exactly
women and
inclusion of
enablement.
women, and there are quite a few things at play there. But again, at the same time, it is leveraging technology so that it works on lower margins, right? Because you're charging lower, which means you work on thinner margins. But in that, it is able to generate very good profits. I mean, we know the kind of profitability it has. I mean, so very good profits because it leverages technology so that the loss ratios are lower, the collection costs are lower, the sourcing costs are lower. So it's a beautiful model. So that is one good example among the companies that both of us know. But in the book, I've covered quite a few other companies as well. India Mart is one such case, which is not exactly in financial services, but essentially it is a backbone for the entire SME economy in India. Right, so many SMEs depend on India Mart, and it provides affordable services for them. Right. Then I talk about Veritas, which is again solving the problem for small and medium enterprises from a financing perspective. Mintify, which is a business very similar to Finag. And one of the business that I like is Better Place, which is actually solving for all the gig workers,
Mhm.
right? Which is a segment that was completely ignored for a long period of time, and they've been able to establish a profitable model around that, right? So quite a few businesses in that sense which are solving. And in a country like India, you'd usually find lots such businesses because there's a large part of the population that is unaddressed, right? Or rather, is not
Underserved.
underserved. Yeah. So in that sense, there's a huge opportunity in India.
I generally say in financial services in India, people are either unserved, underserved, or poorly served, which is even segments like us, right? But I
Yeah,
think we may
that's
have a lot of choices, but really, it's far from an ideal solution. But there are other segments which are completely unserved, and inclusion or just access to financial services are going to be life-changing for those segments, right?
exactly.
Yeah.
Exactly. And India is such a great market for impact investing because when you're trying to provide affordable services, right, you're exactly not trying to squeeze every customer on the margins,
Hmm.
but essentially are playing on volumes. And India is one market which gives you a lot of volumes to be able to
Yeah.
drive those returns.
In some ways, in the FMCG sector, when HUL introduced the sachetization, right, they actually probably had much better unit economics than when they were selling it in bulk to people like us who could afford to buy a 400 rupee bottle of shampoo versus someone who's paying 5 rupees per sachet, but they're probably making a lot more on a per milliliter basis, right? So unit economics, so that was my learning also from some of these journeys, is that you're not necessarily charging less. It's just that you need to be able to leverage technology and build it at a scale where you're able to service the customer, in a manner that makes it accessible. But they're not necessarily paying less than others would.
Yeah, it is very well put. They might not be paying if you look at that way, but ultimately you're trying to make it affordable for them
Yeah.
so that it makes sense.
I have a personal example that I'll share from my very early days in mobile payments with MCheck, where we ran a survey of, um, how much would you pay to pay your electricity bill through your phone? And most air-conditioned office white-collar folks said zero because they all already had 4 or 5 ways
Yeah.
of paying their bill. But you went downstairs to the basement and asked their driver, right? And they would say, 10 rupees without a problem, right? And I asked them what was the logic. And they said, look, typically that for us and most blue-collar workers is we have to give up half day of our salary because we have to, that, we can only get paid when we are at the site. And it costs 20 rupees by bus to go up and down. So, of course, we'll happily pay 10 rupees as a service fee, right? And it really occurred to me, it hit home there that time is money for this segment. And literally, right, people like us can work in the night and can make up or whatever. But for them, if they're not there during those hours, they actually lose income, right? And
Exactly.
it was quite an eye opener for me. And I think this is different examples
Right. The
where this could
hardships of that segment are very different compared to the
correct,
hardships of the.
correct. And it sort of was a lesson for me that the um, those segments in India, they are actually very value conscious. They're not cost conscious, right?
Yeah.
And I think we keep saying India is a very cost conscious market. I really feel we're a value conscious market, and if people see the value, they might actually pay some disproportionate amounts. You're subject to
Yeah.
affordability, of
Yeah.
course.
So the lower segment pays significantly for value in education, in healthcare, because they see value in getting their kids educated. So they pay up a lot more than rich people pay in the sense for the incomes that they have.
Right. So let's talk a little bit on the technology side,
Yeah.
right? Because this is also a segment. The other misconception perhaps has always been that anything impact has an offline element to it, has a people element to it, and has much more of a service, as you said, charity type of an element to it. But technology is possibly the platform on which a lot of this can, typically be leapfrog, right?
Yeah.
To use a pun. So, what are your views on how technology has been used and how is that changing? Also given the digital public infrastructure we have here in India, for example, and the impact of some of that.
Yeah. So technology, as I was just saying, is at least from an impact investing perspective, the key elements that you're trying to drive are affordability and accessibility of service. And on both those parameters, technology is very, very critical. Some of the businesses that we invest in would not even exist. I mean, you could not even dream of those things without technology,
Right.
right? So it is very important. And India, in that sense, is a great, what they have achieved with UPI is phenomenal because we invest across emerging markets. And I tell a lot of the people that sometimes we take it for granted the kind of growth that we see in India. And this became apparent to me only when I started looking at other markets, right? We would assume that we are, our GDP per capita is a certain level. There's a catch up that we are anyways supposed to do. So, and that should happen. But it is not that clear. Without naming the markets, let's say when I looked
Mhm.
at Southeast Asia or Africa, that there's a lot of things that are that India is doing right as a country to be able to deliver that growth consistently year in year out. And
Mhm.
UPI is a great example of the way that they have set themselves up for a long-term growth, right? So a significant portion of the population, which is, as you said, underserved, unserved, are able to access services which are relevant. They're able to unlock that productivity, and that productivity is ultimately the value that is created for the economy, right?
Right.
So in that sense, it's a key enabler technology for all these things.
Mhm. Mhm. Yeah, I was yesterday actually speaking to my domestic health. Her son runs a delivery service, and he used to have a car, and he recently bought an EV, right? And so they, family keeps going. They're not that far from Bangalore, but they go every alternate weekend. And she was saying that it used to cost us 2,000 rupees to go to our hometown, which is Tumkur, which is not too far from Whitefield. But now, he comes in the EV and, we charge it and, go up and down. It costs us 300 rupees,
Wow.
right? And to me, that was, as climate is a big part for a lot of things we all do. And, EV is one aspect of it. But it really hit home because, now I was just telling some of our co-investors in that, based on that example, in the rest of the world, EV is seen as sort of a environmentally better solution. But in India, it's in addition to that, it's actually going to be about inclusion, right? Here's a family that would not have afforded to go buy their own private
Yeah.
car. Now that once they can afford the car, and EVs, of course, are not that expensive anymore. The running costs are actually extremely low, and we also saw in a few other places where people were going from a cycle to an electric cycle because the running cost for an EV was, really, really low compared to they couldn't afford a petrol scooter. They could buy the vehicle, but they didn't have the running costs were prohibitive. But now all of a sudden, the running costs are also getting,
Yeah, yeah.
extremely attractive, right? So,
It is changing. I think there is. all this transition, right? I mean, these are the good examples of what Bill Gates calls green discounts,
Mm, mm.
right? There are discounts available already. The solutions that move us to green are at a discount,
Yeah,
right? Obviously, there are a few things where there is green premium, but this is a very good example of a green discount in the economy.
correct. Correct. Yeah, and the impact of that is just phenomenal, right? Because we are used to reading stories about, Tesla and BYD and all the sort of first world benefits of EV, right? But this is one which I don't think has really been experienced yet at the scale that it can. Um, Maybe we can talk a little bit about the founders themselves, right? Um, because we are all used to sort of the dot-com era of the 90s in the US, and then the mobile first era in India, whether it was the Zomatos or the Swiggies or the Zeptos and things like that, which are sort of bringing mostly conveniences. And along the way, of course, they're employing a large number of people, so there is a strong impact as well. But they're, intended to be sort of high growth companies with a certain type of um, investment structure and a cost structure and growth. I wouldn't say at all costs, but there have been phases in our journeys where there have been some of that as well. Um, and that takes a certain type of sort of a founder who is certainly is sort of the workaholic who is trying to get there as fast as possible, right?
Yeah.
And with generally certain characterizations. But how do you characterize founders leading impact investments, right, or technology based impact investments? Are they similar? What are some differentiations? What is their outlook like? How do you say this is the right type of founder to back for such a startup?
Yeah, so I can share from what our learnings I've had from our investments, right? The critical thing is, the impact goals are our goals. We don't say that this is what the company should do. We try to find an alignment,
Hmm.
saying that, okay, we are trying to achieve this. Is there an alignment? As long as that is there, we're not saying that these should be the company's goals or whatever. So we are essentially trying to understand the businesses. But what we have seen in general is most of our founders are a little more mature, or most of them either mid to late 40s, or maybe late 30s, and they have been in the industry. They have understood the problem statement of the problems that exist in the industry, and they know the solution. They know the people who will get them to deliver that solution. They have the network to solve for that, and that is the common theme. So when I look at our investments, whether it is Finag, where Nipun, he comes from such rich experience in supply chain finance. At Probus, um, it is Rakesh, who comes with again strong experience in the entire distribution space. We invested in Vietnam in a company called TechCoop. Again, the founder there, she comes with a lot of experience in the food space, in the tech and financial services space. So I think that is what, at least maybe that is what we are attracted to, because we are looking for businesses which scale profitably.
Mm.
And this is what, one of the persons in the book also mentioned, from Future Planet. He said there is no impact in having to shut down the business and fire 100 people,
Mm.
right?
Mm.
Ultimately, you need to figure out models which are able to sustain. So for the impact to sustain, the business has to sustain. And because we look for that sustenance of impact, we end up veering towards founders who have solved for that, right? While their businesses are already impact oriented, they already know they've built a business which can sustain, and
Mm.
hence
Mm.
sustain that impact as well.
Got it. So deep domain experience and expertise, understanding of the problem space and the right and the solutions which are financially viable, where the business is going to be around. Because you're right, customers are trying to depend on this business, and it'll be a bigger damage to them if the business goes
Yeah,
away. Yeah.
yeah. So, I mean, this is something that we just learned from our own investments that we have made, right? So they end up being this, and I think this is also because whatever we are looking for is exactly aligns with this set of people.
Yeah, yeah. No, I think having said that, it is interesting now that as we interact more and more with the youngsters also, these are starting to become important criteria for several of them too, right? I think it's impressive to see how um I told my son yesterday that, one of my colleagues is moving into the same gated community as us. And he said, "Oh, so now you both can carpool, right?" I mean, the instinctive reaction was that, okay, now that you can do some sharing here. I was quite impressed. That wasn't the first thing that came to my
Yeah.
mind. But it's interesting that the youngsters also are quite conscious about
Yeah, they're conscious. And I think there's a lot of
question is, can they see a business opportunity there?
exactly, exactly.
Right.
And they're generally a lot more purpose driven, the youngsters these days, than probably we were at that point of time.
You're a youngster compared to me, but yes. Um, so, maybe we can switch a little bit to the India focus and a little bit more back to the book as well. You talked a little bit about, the microfinance sector, and particular our friends at Low Capital have been quite active in that sector as well. Um, you know, Maybe we can dive in a little bit in terms of what do you think they saw at the, when they got into this, and how has that played out?
Yeah, see, this is the exact same question that I asked Vishal as well, as to how is it that most of their firms becoming ended up becoming so successful, which also translated into good returns, right? So their fund two was some 22% dollar IRR in the top decile. So they
Wonderful.
did phenomenally well. And so Vishal himself comes from a bent of mind. He is actually more social oriented. He wanted to do something socially.
Hmm.
He was very socially inclined, wanted to do something in that space, and that's why he came back to India, set up low capital, whatever. And he says that he's trying to understand the exact purpose of the founder, right? He's saying, I want to make sure that this is not something that they are kind of, they saw an opportunity just building it, because then it will not sustain. And when they have the right purpose, then they're thinking of the customer and solving for the customer, and they'll not do anything wrong in that sense, right? Because if you're solving for the customer, in his view, the microfinance is a very simple business. People hardly default, etc. Only when you go over aggressive, or when you're not aligned with what the customer wants, when you over leverage him, that is when you end up making mistakes. If you think from a customer's perspective, then you will not make those mistakes.
Mm.
And he says, that focus has been there throughout all the portfolio companies, because that is the first thing that they check for when they have conversations with the. And he said, 70% of our work was just promoter referencing. What do people think of it? All the other analysis could be 30% of the work, but 70% is promoter referencing, and we want to make sure that they have the right intent or the right thought process on
Very
how
interesting.
to address the customer.
Very interesting. And I think from a founder perspective also, um, during the early days, of course, it's really survival and getting things going. But I think at the end, for all founders, the customer satisfaction, churn, all of these metrics, when you start looking at, it all comes down to the fundamentally the impact you're having, with the customer, right? Whether it's
Yeah, it is very important, but the founder has so many goals and they run after growth. Sometimes they forget that keeping our existing customers happy is also very important. So they don't focus as much on the NPS scores
yeah,
or whichever way, right? And that is where no, they have. I mean, you can't fault them because there are so many things at play: managing the team, managing investors, fundraising, and all these things.
mm,
So sometimes that focus veers away.
yeah, yeah. No, it's interesting. I think I was just reflecting as you were speaking on some of our portfolio companies that we have not fundamentally classified as impact investments, but are actually having a lot of impact in their journey, right? So, in many ways, while for us it's not necessarily the go no go sort of a thing, right? I think in many of the businesses, and we've been debating this a lot also, right? Are there businesses that we will invest in that will wipe out a sector of, of businesses if it is in the success case, or will businesses we do really be accretive to whatever is already out there and people's livelihoods, right? And how will that transform, right? It's a very especially with AI now coming into play, every
Yeah.
business is at risk. And as a VC, in some ways, we have to almost bet that in a success case, it is
No, I
it's
really like
evolving
your
category
portfolio. I
for us.
really like your portfolio. There are so many investments, as you said, maybe are not made with the intent to drive
Express.
impact, but they're really impactful. So I've already met so many founders of your companies, right? And they are really solving it the right way as well, whether it is Navdhan or Finag or Poshan. So really doing good work.
Yeah, no, we're pretty excited. I think all of the companies you named and several others, I think directly or indirectly, they end up having a lot of impact as well. Let's talk a little bit about, if you're a VC fund, right? And most VC funds, of course, are either 8 plus 1 or, best case 10 plus 2, in a few exception case, or 11 plus 3 years. And that's, for those who don't know, that's the life of a venture capital fund. So it's 10 years typically with a couple of years of extension. Um, and the expectation, of course, is that by that period of time, you would have exited all the portfolio companies and subsequently, um, close the fund, right, so to speak. So, from the point of view of impact funds, do LPs have to think about it from a longer horizon, or is it essentially the same? How are they structured?
See, as I said, impact funds, while there are some impact investors, again, some DFIs who are willing to give you that capital for a longer horizon. Ultimately, when you make a fund, it has a reasonable amount of investment from purely commercial investors, and they see the opportunity in impact from a returns perspective, right? And they have similar return expectations, similar time frame expectations. At least most of the impact funds I know follow a similar 10 plus 2 structure.
Got it.
There is I don't know if anybody has an exception, but these days some funds are able to raise evergreen funds or longer tenor funds. Even one of our investors, one of our LPs, was keen on doing something like that. But I think as a pool, when you get all the investors together, 10 plus 2 was the common ground.
Got it. Got it. Got it. And are the IRR expectations identical, higher, lower?
Yeah, so the IRR expectations are very similar.
Mhm.
If it is not, then as I said, capital quickly goes away, right? So and it should go away, because if there is no opportunity, then it's hard to attract that commercial capital, purely commercial capital.
Got it. Got it. So in some ways, from a fund perspective, as you said, the IFC definition, right, of what is the intent, what are the core
Contribution.
areas, what is the contribution, and how are you measuring the impact, are kind of additional parameters to bring into flow. But broadly speaking, it has to fundamentally make financial sense from an investor's perspective as well. And
Yeah.
we're largely batting on that is the North Star metric in both cases, right?
Exactly. So the way and this is at both Leapfrog and Blue Orchard, right? I mean, the way the impact is framed is because there's an opportunity here to serve and create value, and that will result in value for the businesses that we invest in, and in return value for the investors. We're not saying that we have to get concessionary returns or concessionary capital to solve for that opportunity.
Got it. Got it. Excellent. Excellent. So, from founder perspective, as you look at opportunities here, right, what are the hottest areas in your mind, and what are you most excited about? What do you think? Um, what are our startups that would say, okay, I got to take a look at this?
Yeah, so assuming that you have a wider definition of impact, because everybody comes with their own definition of impact, the sectors that generally have seen the biggest activity are the sector that has generally seen the biggest activity is financial services. And it is right in a way, because if you look at even India, right, I was looking at the metrics, and India financial services has grown 50x in last, the market capitalization of financial services has grown 50x in last 20 years,
Yeah,
right? It's a big
it's a
growth,
disproportionate part
right?
of the stock market also.
Stock market. And it used to be already a large segment. It has now become even larger. More
Hmm.
than 30%, 35% is financial services. And as we kind of scale, I think financial services will continue to play an important role, because there's still a lot of work that needs to happen. There is still so much underserved population. So there is a lot of growth still in that segment. The But there are
And that
other
includes the whole BFSI, banking,
banking, financial services, insurance, right?
and investments. Yeah,
Yeah.
yeah.
So yeah, wealth. I mean, we are
Well,
far behind on
mm,
all those parameters. Then, in general, among the other sectors where we see a lot of opportunities these days, and which are also exciting, healthcare, which I worked on earlier, is interesting. There are models which are, healthcare lends itself very well to impact, as well as there are models which are solving for the real needs. Then there is, climate is becoming an important, very important area. And I talk about that in the book as well, that, climate is something that everybody should try to solve for, right? It's the biggest crisis that we are facing, though there is I mean, these days with whatever is happening globally, there is people are not recognizing that as a challenge. And then, other than climate, then we see a lot of opportunity in agri and these areas. So these are the areas that we usually see opportunity.
Got it. Got it. Got it. And um, in terms of the exit criterias and exit opportunities here in India, um, so you're saying exactly the same would apply. So the public markets would be, would be good opportunities for these companies to exit in. Um, do you see any, given that the growth is going to be sort of slightly different from the high growth companies, how do you see the growth stage investor appetite for these types of companies, given, of course, many of them might already be profitable? Do you see different segments coming in there? I know uh, in the tech high growth segment, we've had, the SoftBanks and the Tigers and the Westbridges and some, large names here writing fairly large follow-on capital checks. How is this ecosystem set up?
I mean, you said it rightly at the beginning that India has a good IPO market, right? With whatever has happened structurally over the last few years, the kind of demand there is for IPO is phenomenal. And because we look at across markets, and this is not something that is easy to achieve. So India, in that sense, has positioned itself very nicely. A lot of the LPs are seeing exits only out of India,
Mm.
right? I mean, when they get money, they're seeing exits only out of India. A lot of the other emerging markets, they are not seeing any exits in, right? So in that sense, India is a in a good sweet spot. But then that IPO is an end game for a lot of investors in the value chain, right? So, and that then creates, it just percolates backwards, saying because there's an exit opportunity there, a lot more investors are attracted to this market, and in turn creates a better opportunity for all these firms. Specifically from the kind of companies that we invest in, we find that because we come on board and then fix a few things, not materially big things, but fix very few things on ESG, impact and all these things. It adds an additional element of interest, and a few more people get interested, and
Mm.
ultimately that additional interest counts for uh, better value at some point of time.
So it's interesting. So you're almost saying that everybody who's interested in a regular, financially viable business, plus those who have an add-on thing. So in some ways, there should be almost a premium for these companies because there is more investor interest for
Exactly.
equivalent companies.
Exactly. The higher investor interest in our world, equates to, because the way the private equity world is structured, ultimately there is a one winner, right, for the deal.
Mm.
It's not like a book building process. So ultimately, more investor interest leads to higher valuation in
That's
this
the
market.
best marketing I've heard for impact investing. In the sense that, yeah, you're right. Actually, you're not. There's a certain segment of funds that cannot be investing in the other companies, but that are eligible, that are looking for opportunities in the sector as well. But in addition to everybody else, I think that is
Yeah,
a
so
good
so
point.
ESG has become such a basic thing, right? Because IFC is an investor across so many funds, or all the DFIs that are invested across so many funds. It has become a very important part of assessment for a lot of the companies. And when they come and see a company that the company has already addressed something, there is a definite and it shows in the way the company functions as well. When you have your policies and procedures right, and how you kind of look after your employees, it all adds up. It
Correct.
shows in the company's performance as well when you have the governance systems right. So it helps the company in many ways.
Yeah, I think we're seeing this across the board, right? I think where there are governance failures in companies, it catches up with you in very difficult ways over time. So, regardless of whether it's a requirement or not, it is actually mandatory, right? In any successful company's journey, at some point, this starts becoming the focus. And
Yeah.
in fact, you mentioned Navdan. We were asking Nitin about some of these uh, things, and he said, "Well, you have to put all this in place on the day you incorporate the company." right? In fact, the specific question we asked is, when do you think of IPO readiness? He said all the founders were saying, well, 2 years before or 4 years before. And he said it's on the day you incorporate the company, because you have to get the good habits into the system
Exactly.
very, very early. Maybe a couple of thoughts on the whole, wave of AI and the rate of change in tech. Um, does that pose opportunities, challenges, and historically, impact investment or the founders have not really had a solid CTO. I think that was one of the exceptions that we liked about Finac, right, when we first met him also, and you of course have followed us into this journey. So does that change how founders should be thinking about this when they're starting off now, incorporating tech from day zero?
See, my learnings for AI is largely from what I hear from different CTOs across our portfolio companies, right? We also believed, and one of the investors in the book, Capria Ventures, they were ahead of the game. They hired some, people to start. So on their own, they hired people who would then figure out how to solve for their portfolio companies, how to embed AI. And there are two ways, right? I mean, you try to improve the customer service as of now, the Gen AI piece, or you try to focus on the improving
The
your
core offering
operations.
itself. Huh?
Yeah. So there are ways and means of looking at this, but we ourselves are trying to figure out what is the best thing for our portfolio company. So in March, this March, um, we got all our portfolio companies together in London, and then just to kind of brainstorm and debate what is and learn from each other, right? Because everybody is on a different journey and everybody thinks of it very differently. There are some companies in our portfolio which are ahead and already integrating AI in various ways into their business. So we ourselves, as we go along, are trying to figure out, because there is so much uncertainty on how these things will evolve. But one thing is very certain, that it is very important for everybody to um, incorporate this in their solution, right? Otherwise, you'll be left behind.
Hmm.
So the important thing is not to be left behind. Even if you have to stay at the same place, you have to, figure out how to incorporate these solutions.
Yeah, I think that's well said. I think there is no getting away from it. And in many ways, it makes customer access, the ability to provide more personalized services, because I think this is a segment that needs heavy personalization, and that's actually probably been the bottleneck in the past for, adoption, right? And I think personalization and, instant support, I think people are most hesitant to get on a call a
Yeah,
1-800 number and be on thing. And it's also devastatingly expensive for the other side, right? Where if you're on hold, your both on customer NPS is going down and your
exactly.
costs are going up, right? And I think there's definitely going to be the start of some very efficient businesses here as well, with probably even higher expectations from the customer. So maybe we'll end with some thoughts on some personal questions. What is Mahesh doing when you're not writing a book and when you're not investing in companies? What do you do for fun?
So I have two kids, 11 and 4. And because there's such an age gap between them, both me and my wife have to be involved, taking care of both of them. But outside of that, I enjoy watching sports like any Indian. Cricket is something. So even
Yeah,
if
I know. I was calling
uh,
you the other day, and you said, "Well, the IPL match is starting," and he lives in Singapore. So, yeah,
Yeah, so I follow cricket religiously, test matches as well. And then I try to keep myself a little fit, though it doesn't show. I put in a lot of effort.
yeah. I've just given up on that the show part. I just think I'm very fit. And favorite movies, favorite books, favorite authors.
Uh, so favorite quite a few favorite movies. I watch a lot of movies. So I was born and raised in Andhra. I mean, movies are such a big part of the culture there.
Maybe one from an entertainment perspective and one from an inspiration perspective.
Uh, I quite like, from an entertainment perspective, the recent release that came, Pushpa.
Mhm.
It was not the second one, the first one. Then from a, I think, overall Movies, I think this I'm not able to recollect the name now. I quite liked Shah Rukh Khan's movie that he did with Gaurikar, Ashutosh Gaurikar. I forget the name of the movie. Swadesh,
Sudesh.
exactly. So
Nice. Great. Well, Mahesh, pleasure having you on the show, and I wish you all the best with the book, and of course, with your journey on continued journey on impact investing. Thank you for sharing some insights here, that were a bit new to me, and I'm sure will be to our audience as well. And we look forward to continuing to work together on hopefully more companies. Finac being the first of many.
thank
Thank
you
you.
so much, Sanjay. I really liked it. Thank you, loved it.
Dear listeners, thank you for listening to this episode of the podcast. Subscribe now on your favorite podcast app for free, and you'll be the first one to know when new episodes are available. Just search for Prime Venture Partners podcast in Apple Podcast, Spotify, Castbox, or however you get your podcasts. Then hit subscribe. And if you have enjoyed the show, we would be really grateful if you leave us a review on Apple Podcast. To read the full transcript, find the link in the show notes.